Now, LIFO and FIFO, if it's been a while, here you go. For some people, it's been a while since they've seen them, right? So, okay, here's the input, right? Normal process. How do you buy inventory? You buy, let's think Best Buy, you buy TV number 1, you buy TV number 2, you buy TV number 3. Great. But how do you account for these when you're talking about your cost of goods sold, right? Well, under the FIFO method, which means first in, first out, you're going to say, okay, I'm going to sell TV 1 first, then TV 2, and then TV 3. For LIFO, last in, first out, it's the opposite, right? So let's say this was bought on 1/1. So 1/1, it's a little gross. This is bought on 1/5, so January 5th. And then this is bought on January 10th, right? So they're each bought 5 days away from each other. Now, maybe this is how you actually do sell it. You actually do sell 1 and then 2 and then 3. But you can account for it pretending like you sold 3, 2, and 1. It's whatever method you choose to use. And there are pros and cons to each, right? Reasons you would use each versus the other. You got your periods of rising prices, declining prices. So let's say you bought each of these. And for here, I'm actually going to get a little text box because my handwriting is not the best, as you saw here. But that's okay. I'm using a little trackpad. Well, let's say we bought a TV at $100. We're Best Buy, right? Then this next TV we bought at $200, and the next one's at $300. Now, you might be saying, well, why are they going to increase by that much each date? Okay, fine. Pretend this is, year 1, this is year 2, this is year 3, right? I don't know. This is for example purposes. So this is a period of rising prices, which generally is what we're going to see in questions because that's what happens in real life, right? Prices just go up, inflation happens, prices just go up. I mean, yeah, you could have short-term periods of prices going down, but this is much more like the real world. So something to keep in mind there. The question might say in a period of declining prices. It might ask that. That's fine. Be ready for both. Now, why am I talking about this? Why is this important? Well, because in a period of rising prices, and let's say we're only dealing with selling 2 goods. So let's take out these right here. Let's take out these just to demonstrate the difference. So you bought 100, 200, 300. Now, let's calculate cost of goods sold for each. Under FIFO, this is going to be $300, right? Because we sold TV 1 and TV 2. So cost of goods sold is $300. That was 100 and then 200. Great. Now, cost of goods sold for our LIFO method is going to be $300 and $200. So it's $500. Now, we're under the assumption that you're selling them for the same price, right? That's just kind of what happens, right? So let's say the sale price of each TV is $500. So in this case, you sold 2 TVs. So in both cases, you have revenue of $1,000. However, under FIFO, minus 300 of costs gives you net income of $700. And then if we do LIFO, that's $500. Net income is $500. So you see the difference here that, okay, and they might have a question that says in a period of rising prices, which is going to have a higher net income, higher cost of goods sold. You can memorize that, but I would also be able to write it out, be able to draw something like this out on the test, or at least now while you're learning it, to give yourself a great depiction of what's going on, right? What the heck is going on? Well, here it is, right? We're selling TV 1 for $100. I mean, the cost of it was $100. Cost of TV 2 is $200. So cost of goods sold is different for each. And all these are valid methods, right? Just depending on what you choose to use as a company. I think that was a good intro to all of this. Let's dive into some actual examples with some numbers and have some fun with it. All right, we're always here to have fun.